comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm. Hey there, tax fans. Welcome to State Tax Talks with me, your host, Joe Tantillo. I'm a tax attorney at the Hodgson Russ Law Firm looking to explore the nuances of state and local tax law. Here on the show, our goal is to keep tax informative, simple, and fun. So if you're ready to talk tax, turn up the volume and dive into this episode of State Tax Talks. Hey there, folks, and welcome to another episode of State Tax Talks with Joe Tantillo. I am your host, Joe Tantillo, and I am joined here today by two guests, Mr. Mark Klein and Mr. Drew Wright, both previous guests of the pod, friends of the pod, and we are very happy to have both of these gentlemen back on today. Guys, welcome.
Thank you. Pleasure to be back.
Good to be back, Joe.
Today, we are going to be discussing a topic that is on the lighter side of things. We're going to be talking about the top 10, 20 residency errors and misconceptions that we hear in our day-to-day lives, or as I like to call it, the country club legal advice. You guys know things that I'm talking about without me even to delve into the list, but we're going to break it down for the folks out there today. Just things that you may hear from your friends in passing when you're on the golf course or the tennis court or elsewhere that are not actually pieces of sound legal advice, but are instead mistakes that can get you into a lot of trouble with your change of domicile if you are not being careful. So in an effort to save all of those innocent movers out there, we're going to go through our list of some of our favorites, or I guess some of our non-favorites, or the most infamous bits and pieces of advice and mistakes that we see and we hear. But before we get into that list, I think it's best to just give a quick recap of New York's residency rules for those of you out there who are listening. As a reminder to all of you, New York State uses two different and distinct tests to determine whether someone is a resident for tax purposes. I like to start with the statutory residency test because it is very simple to explain. It's a two-part test, and you have to meet both parts to be a resident. You have to have a permanent place of abode in New York and spend more than 183 days here. And if you have both of those things, you are a resident regardless of your domicile. Which brings us directly into the second test, the domicile test. The home is where the heart is test, a test of a taxpayer's subjective intent. The state tries to read your mind and determine, where was it your intention to make your indefinite or permanent place of residence. And there's a whole bunch of factors that are analyzed. They look at objective actions to figure out subjective intent. We have talked about it many, many times before on this show. If you're interested, go listen to one of those episodes. But those are the two tests that we are talking about today. And the point of this episode is to, make you listeners aware of things that are not true with respect to changing your domicile or with respect to statutory residency. Issues that come up, especially on, initial phone calls for us time and time again. So-and-so will say, my accountant said X, or my friend Bob told me that I can do this, and that's all I need to do to move to Florida. There's a lot of stuff out there that's not true. It can be harmful. It can even be fatal to a New York audit if you are not cautious. So that's what we're going to be breaking down today. And we're going to start with some honorable mentions before we get into, the top 10 here. So honorable mention number one that I wanted to bring up, and I hear this all the time, and this has to do with the home factor, is I will just put my house into an LLC and New York State won't be able to find me. Wrong.
Yeah, wrong, right? I mean, look, it's not a matter of New York finding you. First of all, when you get audited, they're going to ask you a bunch of questions, including, geez, you're in New York, where do you stay? And whether the place you stay is in your name, in an LLC name, owned by a trust, owned by another family member. They're going to figure it out, right? And I always tell people that this question often comes up because people think changing the form of the ownership of the house somehow eliminates my kind of connection to the house and therefore impacts the home factor. I always tell people if there's another reason to do it, right? So, geez, as part of our move out of New York into Florida, we're also thinking about estate planning. And maybe for estate planning purposes, it makes sense to change the legal sort of ownership of the house in New York. There may be some, non-residency related reasons to make that change. If those exist, then great. My advice is always do that. And if we can time the change in the kind of legal relationship to the home around your change of residence, then we can at least use the timing of that change as a change you've made that supports your change of residence. But otherwise, New York auditors just don't really care who the legal owner of the house is, right? They care how you use it. Do you have access to it? Do you treat it as your home?
And I think it also undercuts the argument that you changed your domicile. I think one of the most important aspects in changing your domicile is that verb change. And it's hard to explain to an auditor how you changed your residence or changed your domicile when prior to being, let's say, a Floridian, you used to live at 123 Happy Street. And now that you're a Floridian and you come back, where do you stay? 123 Happy Street. It's, that's not a change.
And speaking of use and finding people, another honorable mention that I've got on the list here is, well, I'll just leave my phone at home and I'll pay for everything in cash. And once again, they will not be able to find me. Guys, problematic, right?
Yeah, I mean, this is one that I hear less and less of, but yeah, I mean, the tracking is a day count question, right? So you get audited and the question of where's your primary home, that needs to be answered. We're going to need to look at where you spend your time. And if you can't prove where you spent your time, then auditors are just going to assume you're in New York, right? So the idea of going off the grid, I'm going to pay for everything in cash. I won't use my cell phone. I won't use a credit card. New York won't be able to find me, right? It's a non-starter because the burden of proof's on us. We got to prove where you spent your time on every single day. And if we can't do that, or the auditors start to think you're playing games with the phone and the credit card, you're just in for a world of hurt, and it's going to make the audit exceedingly difficult.
And I think there's, a lot of concern among auditors that people are less than straightforward in connection with audits. And if they think you are, as Drew said, a game player, they're going to really roll up their sleeves. And I've seen cases actually go criminal. And you think about it, you're down in Florida. I keep using Florida because it's a typical example around here. But you're down in Florida, and every day, phone call, phone call, phone call, phone call, phone call. And then suddenly for 2 months, silence. You never use your phone. It's obvious what you've done. Mm-hmm. And, auditors think, well, if he's willing to play that game, what other games might be played here?
Someone joked at one point, Mark, that they would just strap their cell phone to the back of the dog, right? Send the dog out in the backyard. Meanwhile, I'm going to escape up to New York. Dog's down in Florida. And geez, now my phone's registering in Florida.
We were playing a hypothetical game one time of, in the modern world, is it even possible to leave no paper trail at all, considering all the different things they could look at, frequent flyer records, Easy Pass, et cetera? I mean,
well, forget Easy Pass, right? These days, we don't use Easy Pass anymore. Right. These days, if you don't
just scans,
Pass,
right? Yeah.
It scans the owner of the car and off you go.
Yeah, I don't think that it could be done without being maybe a secret agent and having someone, actually pretend to be you going in different locations.
No, and I had that happen
elsewhere.
I had that happen recently in an audit. We had a client who insisted he was in Israel and that other people were using his car and his Easy Pass and all that. And the auditors found it a little difficult to agree with because when the person was in Israel and his passport showed he was in Israel, the car was never used. When did his friend start to use the car? A day or two before he allegedly came home. And a day or two before or after he left, that's when his friend stopped using the car. So this looks too coincidental because it isn't.
Exactly. How about this one? I don't have any near and dear items. I'm not a material person. Yeah. I don't have any stuff to move. Or the other version of that, I'll just get two of everything.
Yeah, I mean, that's probably the one I hear the most, right? The near and dear items factor, it should be relatively easy, but it's often one that our clients struggle with the most because they often have things in every home, right? I have 2 or 3 homes. I've furnished them and outfitted them the way I like. I have nice things in each of them. And therefore, I don't have a sort of big category of near and dear items that I want to or need to move, right? I hear it all the time. And I push back 4 or 5 times on folks because if people stop and think about it long enough, they will come up with something. And I always tell people it doesn't have to be a long list, right? I don't need you to come up with 50 near and dear items, things that are important to you. But I need you to come up with at least a couple, right? If you're not a material person, you might not have a ton of stuff that falls into this category, but you got to have at least a few. We need to identify them and we need to think about, locating those things consistent with what you're saying with respect to your domicile.
And I think auditors often conflate the concept of a near and dear. I look at the near and dear factor as an emotional connection to something, pictures of the kids growing up, grandma's china.
Yeah, the teddy bear.
The teddy bear, exactly. But if auditors see that you've got separately insured artwork or separately insured jewelry, or you've got a safe deposit box up north, they're going to wonder, gee, isn't that a near and dear item? And it may not be. I've had many clients who've left their artwork in New York because it stays in an air-conditioned doorman building where it's quite secure, and their New York place has security, which is the front driveway. So there are reasons, but auditors will focus on the financial value as well. And you know what? I usually ask people, if you had 15 minutes to leave your house, what would you grab? What's that important to you? And 90% of the time, they don't say their spouse. So.
What about the dog?
The dog comes with them every time, even goldfish.
Well, there you go. Yeah, it's an interesting one. I find auditors often get hung up on, moves of like furniture and dishes and clothing, which to me, I agree. Those are not near and dear items. That's just stuff. Near and dear items are, a wedding album or a family heirloom, your grandpa's pocket watch that he had with him in World War II. What's that? Catch Me If You Can?
What makes your old house a home, right?
Yes.
You can have 1,000 houses, but there's something about the place. I mean, maybe it's you got, as the kids were growing up, you took their measurements and you've got, a ruler somewhere that has all their marking. I don't know what, it's different for everybody, but there are things that make a house a home, and that's the kind of thing you're looking for.
You have a client, Mark, who is an art dealer, and when I was talking to him about this factor, he said one of the things that is really near and dear to us is this painting that we commissioned from a famous artist of our children. And I said, great, let's move that to Florida. And he said, well, there's only one problem. The painting is a mural on the wall of the New York City apartment. So there are, that kind of stuff comes up. And then we had a long discussion about, well, he was looking into, is there a possibility of kind of removing it in a way where we retain it? And now he's thinking the artist that actually painted it is an artist of some renown. Maybe it has some monetary value. And it's not something because of the nature of what it is that he'll ever be able to move to Florida, I don't think. But instead, we've pivoted to, well, what can you do to try to dispose of it differently now that you're not a New Yorker? If it has some value, let's maybe think about selling it. Right?
You bought him a can of paint?
That's right. Well, I mean, he joked about it, right? We'll paint over it. I'm like, I don't want you to do that, right? Yeah. It's, it's a piece of art.
And I think, look, the whole reason that New York has this near and dear test, and it's not just New York, most of the Northeast states have the same 5 factors.
Right.
But the thing that interests me is the auditors focus on the fact that your nearest and dearest things, you want them to be with you. And that's true. But if there's a reason you can't have it with you, then as long as the auditor knows it has nothing to do with, not loving it as much or whatever. I had a client with a gun collection. And they were seriously into guns. And I said, you've got to move your gun collection to Florida because that's the place that we expect your nearest and dearest things. And he got a letter from his gun person who said, are you serious? They're going to rust. They're going to get salt air, all these things. So that way, at least you're able to undermine the presumption that your nearest and dearest things are up north because you love them and you want to be with them. No, it's because I don't want to destroy their value. So, but you have to do that. If you do that while you're audited, it loses a lot of credibility.
Yeah, I remember we had an audit with a client that had like a vast collection of wine and had a very specialized like wine containment facility in New York State. And they were like, what it would cost to rebuild the same facility. Like it was all custom built for them and they ended up not having to move it. So, okay. Next one on the list of the honorable mentions, I thought was a good one to bring up. I hear this all the time. It's usually at the end of planning calls. Oh, by the way, once I'm a Floridian, I won't owe any more tax to New York State, right? Like I'm good. I'm done paying New York State taxes. Not necessarily.
Yeah, if you're one of the lucky few who has no income from New York sources, you might find yourself in that situation. But much, much more common, right, is for us to talk to folks who are making this move. They become residents of a different state. They don't pay tax to New York on worldwide income anymore. But almost always, people still have some income that will come to them after the move that is from New York sources. And of course, we still got to pay tax to New York on New York source income, even after we become residents of a different state.
Yeah, and think about it. I mean, if a client goes to Florida and never returns, well, they don't need us or anybody else. That's a very easy case. But if they return and they're still making money, they're employed by somebody somewhere, they automatically have, New York income, even though they're just here for the summer.
Mm-hmm. It breaks a lot of hearts when you tell people that they're still going to pay some level of New York tax, but it's the reality, because it's the second piece of all these residency audit rights. It's the allocation piece. They're going to solve the question of domicile or statutory residency, and then they're going to take a hard look at your returns and your W-2s, K-1s, et cetera, and figure out how much blood they can continue to get from the stone.
Yeah, and even Joe and I were talking about a case just this morning where the client absolutely moved to Florida, and can't believe that New York would even care about his W-2, except part of his W-2 was a bonus that he earned for work the previous year where he was in New York. And the auditors have asked for information to try to break that out because, New York cares about where you were when you earned it, not where you were when you got it.
Exactly.
Well, and your point, Joe, about raising this issue in the context of having a planning discussion is a good one, right? Because there's nothing worse than the situation Mark just described where someone made a move. They're going to win the residency thing. It's rock solid. They really moved. And then we have to be the bearers of bad news where we tell them, but you still owe a boatload of New York tax because of this sourcing question. Whereas when you can have that discussion on the front end of a planning engagement, then people go into this with their eyes open, right? And
they get mad. Otherwise, they think I went through all of this for nothing.
What have I saved?
Art is excited about staying in Florida as long as they might have to stay there. And they go through all of this effort. And for what? Not as much as they thought.
Well, and that's what happens a lot of times, right? Is you have that discussion and then people do the math and they say, oh, geez, maybe there's not a gigantic benefit. I'm not going to upend my life to really make this change of domicile. And they just do something different.
I talked to someone recently where they decided not to move because almost all of their income was from, options that had the grant to vest period was pretty much entirely within the period of their residency. And they were like, oh, so I'm going to have to pay tax on pretty much all of this massive gain anyway, even if I move. Yes, you are. Okay, I don't think I'm going to go to Florida for that much time.
I just had this conversation last week with someone he's retiring. He's got big deferred comp coming in for the next 5 years. We looked at the plan documents. It's not the kind of deferred comp that's going to be treated as qualified retirement income. He earned it all working in New York. And we had the discussion and we said, you're probably not going to save a lot of New York income tax over the next handful of years. And he's still making the move, right? He decided, well, there's some modest benefit, but also, thinking about estate tax savings and things like that.
Sure.
He's still going to do the move. He's just going into it with kind of open eyes about what the income tax impacts are going to be.
The distinction between the deferred comp that does qualify for the federal protection and that doesn't has come up for me a couple of times recently. And I would implore all of those of you out there who have deferred compensation coming to you that perhaps you are assuming is going to be protected in the event of a move to talk with your accountants or your tax attorney and find out more, because not all plans are treated equally under federal protection.
And even option income, whether they're non-qualified, usually non-qualified, or RSUs, people very often look at the rules, and the rules say you look at how much time you spent in New York between the grant to vest date. And so sometimes people move to Florida and they retire, but the vest date isn't for another 2 or 3 years. So they assume, now that I'm in Florida 2 or 3 years, I've added all of this additional Florida time to my numerator, so I don't have to pay tax on it. And unfortunately, if they were to read carefully, they would see that the rule says from grant to vest or date you retire, stop working, because you put your total number of days in the denominator, and if you're not working, those days don't go in the denominator.
So be cautious with deferred compensation. There's a lot of tricky things there. But back to the residency discussion. That's enough on allocation for now. We're moving from honorable mentions into the top residency.
And actually, I want to give you one more honorable mention.
Please do.
Because this is one I hear all the time. People that come to me, especially during seminars, at the end, and they'll say, all those things you spoke about were fascinating, but I went down to Florida. I filled out an affidavit of domicile. I registered to vote. I got the homestead exemption and I registered my cars there. The clerk of the county in Florida said, you are now a Floridian. Clearly, I'm a Floridian. And that's really nice, but New York really doesn't care, right? New York says, look, the fact that you went down to Florida and filled out a lot of paperwork indicates you're really good at paperwork. It doesn't mean you became a Floridian, at least not in New York's eyes. I mean, the rules with Florida and New York are not consistent. They're actually mutually inconsistent at times. And that raises a lot of problems because people are lulled into a false sense of security that my move to Florida has been respected by the authorities, meaning the Florida clerk, but New York really doesn't. I mean, those are always nice things to do. And I think, Drew, we tell people to do them, but please don't put a lot of credibility on the fact that you're a Floridian because you're really good at filling out paper.
Yeah, the Florida clerk is not going to show up to your audit meeting and defend you or testify for you at your hearing in all reality.
Well, it gets to the kind of country club advice you mentioned, right? Because we talk to people all the time and they say, well, my buddy said you spend 190 days in Florida and you do your declaration, you get your driver's license, and that's what he did, and it worked for him. So why won't it work for me? My question to those folks is always, did your friend get audited, right? Because if you don't get audited, anything works, right? Because no one's asking you questions.
And there are a large contingent of people who don't get audited, and usually they're the people who don't make as much money as the ultra high net worth folks. The more money you make, the more likely it is that New York is going to pick your tax return out of the pile and, run you through the ringer.
No, New York is very smart about deploying its limited audit resources.
Yeah. Okay, into the top residency errors, and the first one, this is in no particular order. Unfortunately, this isn't, a YouTube countdown where we're going to go number 10. But what I have put at the top of the list is the one that we hear most frequently, and that is, I spent 6 months and a day in Florida, therefore I am a Floridian. That is not the law.
I was down in Florida a couple of years ago, and I went to a hotel. And the woman that registered me said, so what brings you to Florida? And I said, I'm giving a program. Oh, what's it going to be on? A residency, Florida residency. Oh, I know, she said, 6 months and a day. And I thought, if that was the case, it would be a very short seminar. That's just not the rule. I mean, I'm sure you've gotten into this in other podcasts, but New York requires you to prove that you've become, let's say, a Floridian. We keep using that as an example by, quote, clear and convincing evidence. And I don't know what clear and convincing means, but I know what it doesn't mean. If you're spending 6 months of the day in Florida and the other 5 months and 30 days in New York, you're going to have a very, very difficult time, because that, in my mind, is probably not clear and convincing unless you have other factors lined up.
Yeah, I mean, on a regular basis, people will call us and ask for residency advice. And then during that call, they will assert the 6 months in a day non-rule as if it were a rule. And the first thing I always think is, why are you calling us if you're so certain that this is the rule? You must have some level of uncertainty, and yet the tone in your voice suggests to me that you think you've got this all figured out. And I always have to break it to them that I know that your pal told you that this is all that it takes, or you saw Dave Portnoy posted on his Instagram story, which was a real thing that happened. Tried to DM him and say, Dave, that's not the rule. If he gets audited, maybe he'll call us. But it is an interesting misconception, and who knows how it got started, right? But it's so similar to the
183-day rule, the statutory residence.
Yes.
And I can't tell you how many times clients say to me, no, I have the strongest residency case in the world. I can prove I was not in New York more than 183. And in fact, I spent 183 plus 1 in Florida. Yeah, but there's a lot of other factors. No, but look at my day count. And they somehow think that's the only test. And obviously not the case. Yeah. There's
just so much more that goes into it, as you mentioned, Mark. And even if it were just the time factor, that wouldn't be good enough. It's like that's like a preponderance of the evidence, right? Like 50.1% would be 6 months in a day. And clear and convincing is just much higher.
Yeah, and it's just the time factor for domicile is much more nebulous, right? There is not a bright line test for day count under the domicile test. It's just a comparison, right? How much time are you spending in the place you claim to be your home versus New York? And to Mark's point, it really can't be close, right? If it's close, how are you going to prove it's clear and convincing? You got to spend a lot more time in your new home than you do in New York. And if it's just 6 months in a day, it's going to be hard to prove that you've met that really high burden of proof.
And the other thing people get very confused about, and I get it, is let's assume I'm in New York 4 months, I'm in Florida 4 months, and I'm traveling to Europe or California or elsewhere for 4 months. That to me could be a very tough case. Mm-hmm. And my clients look at me like I'm crazy, because they'll suggest, you don't get it, Mark. I'm out of New York 8 months a year. That's clear and convincing. And we have to point out, yes, you've absolutely left New York under New York's rules. But as you know, it's a two-step process, right? You got to leave and land. And it's hard to say I landed in Florida when you're in Florida just as much as you're in New York. It's the same amount of time. And auditors don't care about Europe or vacations or elsewhere. They compare, as Drew just said, your old home to your new home, 4 months to 4 months. That's 50-50. That's not clear and convincing.
Yeah, might as well be 6 and 6 at that point, right?
Yeah, it's not enough. Listening to this podcast right now, we are definitively telling you that 6 months in a day is almost certainly not going to be good enough on its own to win your audit. So despite what your golf foursome is telling you every Sunday at the country club, unless they are tax law professionals of some sort, I would not listen to them. All right. The next one is moving on January 1st. Mark, I know this is a favorite of yours.
Yeah, well, it really became a favorite of mine after an auditor supervisor mentioned it to me. And that was probably going back 20 years now, but when they used to pick returns for audit by hand, they used to all go to Albany and sift through all of these returns that had lots of income and non-resident, decide which ones. And one of the preferences they gave were for people who claim to change their domicile on January 1st. And there's two reasons for that, right? Number one, auditors, as I mentioned at the outset, expect that when you move to wherever, you got a moving van and you moved. And they're really impressed that you were able to find a moving van on New Year's Eve or New Year's Day. That's not usual. The second thing is, the auditor will ask, well, where did you spend New Year's Eve? Oh, my beautiful new home in Boca. Well, where'd you spend New Year's Day? My beautiful new home in Boca. So let me get this right, says the auditor. So somehow between when you put your head on the pillow at night and you woke up in the morning, you moved to Florida. It just doesn't make sense, right? I mean, and you think about it, and it's absolutely true. Very infrequently will people move on January 1st. In fact, I think there's an article on the web somewhere, nobody moves on New Year's Day. Mm-hmm. And I think that's generally accurate. And what I think happens for the most part is that you moved at the end of the preceding year.
Yes.
And, maybe you were in New York too much by then, so it didn't really affect your taxes. But we always tell people to put a notation or something in the form to reflect the fact that you're not claiming January 1st, because that becomes problematic. I mean, the day you change your domicile is the day that you're in New York on day one, and now you're living in new place from day two on. That's the day you change.
Yeah, for me, ideally, if you moved in December of 2023, even if it was December 29th of 2023, sure, you're going to be a statutory resident of New York, but I always tell people, throw some sort of rider on there. Let them know you're filing as a statutory resident, you're claiming the change of domicile as of December 29th or whatever it is, and that way the next return that you file is going to be a non-resident return instead of one of those, a non-resident return that doesn't have a January 1st move date listed on it, and minimize the red flags.
Yeah, I think the sort of the broader advice on this trap is be intentional about the date you choose, right? Mm-hmm. So choosing January 1 often is done because it makes filing easier, right? I go from being a full year resident to a full year non-resident. It makes the sort of reporting of the move simpler. But it very often happens we get a return that lists a date that's not January 1st. And then we start digging into the facts and circumstances of the case, and the date makes no sense, right? This is a date that does not align with the actions that you took to change your residence. And so, the sort of more specific advice I think on this trap is think about and be intentional about choosing a date that you report your move that coincides with your actions, right? You want the date to meet actions you've taken to support your intention to change your residence.
Yeah. And it's important to recognize, going back to our earlier discussion about leave and land, Drew and I have a couple that we're working with right now. They've been New Yorkers and they're moving to a Midwest state, and they want to leave New York and, they're going to spend their time somewhere else for the next couple of months and then become Floridians, or in this case, it's a Midwest state. They say, look, the day I'm leaving New York is this date, so I can change my residence, right? And once again, since they don't land, it's hard to be a resident of a state when you're not physically sleeping there. Mm-hmm. And so we had to tell them, unfortunately, that the time they spend in, Cape Cod or wherever they're going to be for a couple of months doesn't help them, because New York will continue until they land in their new home and start living there. That's the date you change your domicile.
Yeah, and listing one of those nebulous dates like, January 1st or a date when you're not really kind of spending extended time in your new place of domicile yet can really undercut the audit. I mean, we've had auditors bring up, so-and-so listed this date, but now you're saying that wasn't really the date, and maybe you have good reason, but, why would they put that we put a lot of stock in, the date that they signed the tax return. They verified the information is correct, and now you're telling us it's something different. What else isn't true? So it's not good. You want to avoid that. And I had an auditor tell me just this week, actually, they said, we've looked at all the information you've sent and we just don't see any sort of clear event until, X day that would represent some sort of big life change that would make someone want to actually change their domicile. So they do dig in. So caution there. All right, gentlemen, this is a great time for us to take a break. We're currently having a conversation about the top residency traps that we see in New York State audits, but we're going to pause and we're going to bring it back for part 2 of this conversation with Mark Klein and Drew Wright in the next episode of State Tax Talks. Until then, I've been Joe Tantillo. We'll see you soon. Thanks for joining us for another episode of State Tax Talks. If you're interested in listening to more episodes, we're available on all platforms where podcasts can be found, including YouTube. If you enjoyed this episode of State Tax Talks with Joe Tantillo, please give us a 5-star review on your favorite podcast platform. And if you're in need of a tax professional, you can contact the tax attorneys at Hodgson Russ. Go to www.hodgsonruss.com for more information. And until next time, I'm Joe Tantillo, and this is State Tax Talks. Catch you later, tax fans. The comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm.